Imagine waking up to the news that U.S. forces just struck military targets in Iran.
Yeah, which is, an incredibly tense situation right out of the gate.
Exactly. And almost immediately, Iran's foreign ministry fires back, right? They accuse Washington of blatantly violating an existing ceasefire framework.
Right.
And if you're listening to this and you're looking at your retirement portfolio or, I don't know, trying to figure out if mortgage rates are going to drop anytime soon, your natural instinct is to brace for impact.
Oh, absolutely. You expect everything to go crazy.
Right. You expect oil prices to just shoot through the roof, inflation alarms to blare across trading desks, and this massive, chaotic flight to safety in the bond market.
Because that is the standard playbook for a geopolitical shock.
But instead, and this is the crazy part, the markets just relaxed.
Yeah.
Oil prices plummeted, and Treasury yields actually slipped lower.
It looks completely contradictory on the surface. We have these kinetic military strikes in literally one of the most volatile, oil-rich choke points on the planet, and Wall Street basically lets out a collective sigh of relief.
Right.
It defies traditional geopolitical logic entirely.
Which is exactly why we are unpacking this today. Because this counterintuitive market reaction, it actually holds the key to the future of global inflation.
Yes.
The trajectory of interest rates and, ultimately the cost of everything from your weekly groceries to your next car loan.
It really does affect everything because traders are pricing in this very, very delicate geopolitical maneuver right now. And if the physical reality on the ground deviates even slightly from those expectations,
It's going to be a disaster.
yeah, exactly, that optimism will evaporate overnight. The stakes are incredibly high.
So the mission for today's deep analysis is to decode what financial insiders are calling the peace trade.
The peace trade.
We have to determine if the market is actually accurately predicting a diplomatic breakthrough here, or if investors are just, blindly ignoring the smoke from a profoundly dangerous escalation.
Right. Are they right or are they just complacent?
Exactly. Okay, let's unpack this. Because to understand this massive contradiction, we first need to look at the raw data of the bets being placed.
Yeah, the underlying details of the strikes really dictate the market's response here.
Right. So the U.S. carried out strikes in southern Iran targeting very specific assets. We're talking missile launch sites and Iranian vessels that were allegedly attempting to deploy naval mines.
Right, and the framing of this is crucial.
Yeah, because the Pentagon framed this as a strictly defensive action, right, to maintain the current ceasefire framework.
Exactly. While Iran countered and called it a direct violation of that same ceasefire.
But the numbers in response to that, that's what I just can't get over.
They are wild.
I mean, in any standard crisis playbook, the 10-year U.S. Treasury yield spikes, right? Because inflation expectations soar. Instead, it fell. It fell by 1 basis point to 4.481%.
Yep.
And the 2-year yield slid down to 4.035%, while the 30-year yield declined to 5.01%. Just a quick reminder for everyone, a basis point is 0.01%, and bond prices move opposite to yields. So yields falling means people were actually buying bonds, but not in a panic.
Right. And we saw the exact same pricing logic in the energy sector, which is even more surprising.
Brent crude closed down over 5% at $94.29 barrel, and WTI dropped over 5.5% to $88.68. Oil tanked.
What's fascinating here is how the market is separating political rhetoric from the physical consequences.
What do you mean by that?
Well, traders aren't ignoring the smoke, right? They are looking right through it to the end game.
Mm-hmm.
This is the peace dividend trade in action.
Okay.
The market is calculating that the economic cost of a prolonged open-ended disruption in the Strait of Hormuz is simply too high for both Washington and Tehran to sustain.
So they don't think it'll escalate.
Exactly. They're treating these strikes as brinkmanship, not as the start of an open-ended war.
I mean, I hear that, but I still struggle with the underlying optimism there.
How so?
It feels a bit like, watching your neighbor's house catch fire and deciding right in that moment to lower your own home insurance coverage.
That's a great way to put it.
Why on earth are investors ignoring the fire? Missiles are flying, ships are allegedly deploying mines. Treating that as a signal that the inflation shock is cooling just feels, I don't know, reckless.
It definitely looks reckless until you view it through the lens of leverage.
Leverage. Okay, explain that.
So institutional capital is treating these strikes as the final high-pressure phase before a diplomatic settlement.
Like the climax of a movie.
Exactly. When bond yields fall and oil drops simultaneously, traders are essentially betting that these strikes are calibrated.
They're planned out.
Yes. They view the military action not as the opening salvo of a wider conflict, but as this severe negotiating tactic, one that won't actually choke off the global energy supply.
But, okay, wait. Why shoot if you are trying to shake hands? If both sides actually want a workable deal, dropping munitions seems incredibly counterproductive.
It does.
That points to a hidden objective here, right? Something specifically centered around how the Strait of Hormuz actually operates.
Spot on. And the core friction in these negotiations is Iran's push to establish a formalized transit fee for international shipping going through the strait.
Wait, really? A fee?
Yeah, they are trying to implement a tolling system on literally one of the most critical energy arteries on Earth.
So what does this all mean? Are they basically trying to turn a global waterway into a private turnpike?
Yes.
We're talking about setting up, like, an easy pass lane, but surrounded by military destroyers.
That is the mechanical reality of what they are attempting to do here.
Wow.
If Iran can formalize a toll, it creates this massive permanent revenue stream. And the key is that it's highly resistant to traditional financial sanction.
Because it's a physical choke point.
Exactly. It embeds a continuous geopolitical tax right into the global energy trade.
And obviously the U.S. red line is absolute freedom of navigation.
Completely.
Washington completely rejects the premise that international energy lanes can just be transformed into forced toll zones.
Right, which explains the naval mines.
Because the mines are essentially acting as military turnstiles, like a permanent physical tax. You can't force a commercial supertanker to pay a transit fee unless you have the physical capability to stop it or delay it or sink it.
Precisely. So the U.S. targeting those specific mine-laying vessels, that was not just a random show of force.
It was a message.
It was a physical rejection of Iran's attempt to build those facts on the water, as they say. You build a toll booth, the opposition dismantles it.
That makes total sense. Both sides are executing these very calculated leverage strategies.
Yes, exactly. To be clear, we're just looking at the mechanics of the strategies here. The U.S. is applying kinetic pressure to enforce freedom of navigation, and Iran is applying choke point pressure, utilizing the threat of restricted transit to maximize their leverage.
To get things like the release of frozen overseas assets and broader economic relief.
Right. Both are playing a very high-stakes game.
So this is literally negotiation by fire.
Negotiation by fire.
Diplomacy is still happening, but it's happening through limited force and calculated threats to prevent the other side from gaining a tactical advantage before any paperwork is signed.
Exactly.
But okay, let's assume the bond market is totally right.
Okay.
Let's say this negotiation by fire is working and a deal is actually imminent. There is still a massive disconnect between that optimism and the physical price of oil.
How do you mean?
Well, crude is down, sure, but it's stubbornly sitting near $94 a barrel. If peace is fully priced in, shouldn't crude be sliding back toward, like, normal pre-crisis levels, like $70?
Right. Well, erasing panic from a trading algorithm takes a millisecond, right?
Sure.
But erasing physical risk from a shipping lane takes months.
That's true.
Even if a comprehensive peace treaty was signed this very afternoon, the practical commercial realities remain. Like the Joint War Committee at Lloyd's of London, they set the guidelines for marine insurance.
And they don't care about handshakes.
Exactly. They care about physical safety.
Right. Commercial shipping companies aren't going to just send a $100 million oil tanker into a zone that was literally just heavily mined without real assurances.
No way.
And those assurances cost a lot of money.
They do. War risk insurance premiums remain astronomically high right now. And before any normal transit resumes, you have to conduct physical sonar sweeps.
Right, to clear potential mines and debris.
Yeah, you have to execute thorough port inspections, repair damaged coastal energy infrastructure, and begin the really long process of rebuilding strategic petroleum reserves.
The ones that were drawn down during the initial panic.
Exactly. So all of those logistical hurdles keep a really firm floor under the price of oil, trapping it up there in the mid-90s.
Here's where it gets really interesting, though. Because oil is just the first domino, right?
Right.
How terrified is the Federal Reserve that the shock won't just stop at the gas pump, but will actually bleed into everything from our groceries to our wages?
Oh, they are highly concerned. If we connect this to the bigger picture, the Fed is hyper-focused on these second-round effects.
The second round effects.
Yes. Think of the oil market like an international airport right after a major security threat.
Okay.
The authorities can give the all clear, they can lower the threat level, but flights don't just instantly normalize.
Right, everybody's still out of place.
Exactly. You have to restring passengers, reposition aircraft, sort out delayed logistics, get the flight crews back into rotation.
And that delay is incredibly expensive.
Right. And that logistical delay is exactly what keeps inflation sticky. Oil at $95 isn't necessarily a catastrophic shock that causes a global recession all on its own.
But it functions as an energy tax.
Exactly. An energy tax on every household and business. Because fuel powers all logistics. It dictates the cost of aviation, shipping, food delivery, everything.
So when fuel costs remain elevated, business margins shrink. And companies eventually pass those costs right on to consumers.
Which means living costs rise. And as they rise, workers obviously demand higher wages to compensate.
And suddenly, a temporary spike in the Strait of Hormuz translates into sticky core services inflation and rising producer prices back in the U.S.
Yes, which completely derails the narrative that the Fed is going to cut rates soon.
Because Wall Street has been practically begging for a rate cut.
Oh, pleading for one. But with oil hovering around $95, the Fed's hands are basically tied. The Fed funds target range is likely going to stay anchored at 3.50% to 3.75% for much longer than the market originally modeled.
So we are just trapped in this macroeconomic middle zone.
Yeah, the energy tax is low enough to avoid triggering a severe recession panic, but it's way too high to justify easing monetary policy.
So when do we see a cut?
The updated path suggests we might see maybe one small cut late in 2026, and that's only if the labor market shows significant undeniable weakening.
Wow. And complicating that timeline even further is the potential leadership transition at the Federal Reserve itself.
This is a massive variable.
Because the possibility of Kevin Warsh taking the helm changes the entire dynamic of how the central bank communicates with the market, doesn't it?
It really does. A potential transition to Kevin Warsh leadership means operating with a fundamentally different philosophy regarding forward guidance.
Because over the past decade, the Fed has heavily relied on signaling their moves months in advance.
Right, to hold the market's hand. But Warsh is famously skeptical of that heavy forward guidance approach. He leans towards strict data dependency.
Which means meeting by meeting uncertainty for investors.
Exactly. Without that dovish signaling, the market has to guess the Fed's next move by hyper-analyzing every single inflation print and jobs report.
That sounds exhausting for the markets.
It is. And beyond just the interest rate uncertainty, a Warsh-led Fed might lean more heavily on quantitative tightening, or QT, to battle sticky inflation.
Right. Just to briefly explain for anyone who needs a refresher, during a crisis, the Fed expands its balance sheet by buying assets to pump liquidity into the financial system.
Right.
QT is the reverse. It's allowing those maturing assets to roll off the balance sheet without reinvesting the proceeds. It drains liquidity from the system.
Exactly. The Fed might accelerate that balance sheet reduction to tighten financial conditions without having to raise the headline interest rate.
Which makes sense because raising rates is a much more visible and politically sensitive lever to pull.
Exactly. So that combination, sticky oil, a data-dependent Fed, abandoning forward guidance, and sustained quantitative tightening, it creates a very, very fragile environment.
So the bond market is optimistic, but they aren't blind. They are basically making a massive fragile gamble that the peace trade won't blow up in their faces.
That is exactly what's happening.
So let's look at how this actually plays out, the two diverging paths here. Let's start with the bull case.
Sure. The bull case is essentially what the market is pricing in right now. A deal is reached between Washington and Tehran. The Strait of Hormuz is gradually swept and reopened.
Oil prices stabilize and start that slow glide downward toward normal.
Yes. And because that energy tax cools, inflation expectations fall. Treasury yields remain contained.
And the Fed can afford to stay patient.
Right. Risk assets benefit from the drop in geopolitical stress, and the strikes just become a footnote.
Just ugly pressure tactics used right before a handshake.
Exactly. But the bear case, that is where the structural integrity of the global economy really gets tested.
Right. What happens if this negotiation by fire miscalculates?
If the ceasefire collapses entirely, and Iran actually deploys those naval mines, that tolling demand becomes a physical reality. International tankers get blocked.
And in that scenario, oil doesn't just stay sticky at $94.
No, it surges well past $100 a barrel.
Which means inflation expectations spike instantly, forcing Treasury yields to reprice violently higher.
And the Fed is immediately forced to turn aggressively hawkish. Rate hikes are suddenly back on the table, and risk assets sell off as the market realizes the geopolitical tax is permanent.
So the global economy is basically balanced on the edge of a naval mine right now.
It really is. Which raises an important question. How do everyday people and investors actually navigate this?
Yeah, because the noise is deafening. You have military posturing, press conferences, bond traders making these wild bets. How do you separate the signal from the noise?
The practical way forward relies on looking past the political rhetoric. You have to watch the physical logistics of the Strait of Hormuz. That is the true, unfiltered pressure valve for global inflation.
So you watch the water, not the podium.
Exactly. Are commercial ships actually moving? Are marine insurance premiums dropping? Are specialized vessels actually out there conducting sonar sweeps to clear the mines?
Right, because the physical flow of oil through that specific choke point is the only metric that cannot be spun by politicians or manipulated by algorithms.
Spot on. If the logistics remain stalled, the inflation threat remains active, regardless of what the bond yields are doing today.
So just to summarize, all of this falling yields and sliding oil prices mean we are looking at a market firmly positioned for peace.
Yeah.
They believe the U.S. strikes were controlled leverage and that the inflation shock is cooling, but that optimism is exactly their biggest vulnerability. Because in a crisis built around shipping lanes and heavy munitions, one single miscalculation by a commander on a boat can turn a peace trade into a systemic inflation shock overnight.
It highlights a truly precedent-setting moment in modern geopolitics. The concept of utilizing a military choke point to extract economic rent is basically being tested in real time.
Which leaves us with a thought that stretches far beyond just oil in the Middle East. If nation-states successfully pioneer the use of military toll booths to tax geographical choke points like the Strait of Hormuz, what happens when this model evolves?
That's the real fear.
Right. In the future, could we see geopolitical tolling applied to other critical global infrastructure?
It's entirely possible.
Imagine a scenario where a nation decides to leverage something like undersea internet cables, the ones that carry 99% of global data. What about restricting international airspace or using anti-satellite weapons to tax space-based communication networks?
It's a completely new paradigm.
Will the future of global trade require a geopolitical tax permanently built into the price of human connectivity? It's a chilling concept, but it's exactly where the math and the leverage strategies are pointing. We'll leave you to ponder that one as you watch the physical logistics of the markets this week. Keep questioning the consensus and stay curious.